Let's talk about book valuation, a technique we use to accurately determine the value of a book at an arbitrary date in the future. In addition to the value of the securities on the target date, it's also important to know that we factor in any changes that might occur to your cash position, such as those due to dividends or transactions along the way. Let's walk through a simple covered call example. Assume today is January 25th and we're long 100 shares of a stock and short one call contract for March 18th at 105. In this scenario, we'll value the book for three potential future prices. The stock does not distribute any dividends between now and March 5th, and there won't be any expiration-related transactions. As a result, our cash change would be zero, regardless of the underlying price. Next, we'll factor in the value of the underlying shares, which is easy enough. The final step is to value out the short call position, which is a little more complex. The value of an option is driven by a set of 6 key factors. The underlying price is a given for each model, and 4 of the remaining factors are going to be the same regardless. However, the implied volatility is a special case because its value is going to vary based on where the underlying is trading on the target date. To properly select a volatility to use, we'll need to employ a future volatility skew shift. A volatility skew is simply a chart of the implied volatilities for a term mapped against their respective strikes. In general, the skew will be at its highest in the lowest strikes and slope downward until it bottoms out around the forward price of the stock, which is also today's price in this scenario. After it reaches the forward price, it may slope in any direction for a variety of reasons. Because this is the term for our option, we know that the volatility for the short call at 105 is 34.59. However, it won't necessarily still be at that volatility on March 5th, so we need to do some work. First, let's add the February 19th volatility skew into the picture. This is the closest expiration that occurs before the target date, so it's important to provide context for the March 18th data. As you can see here, it has a significantly higher volatility, which is indicative of increased risk that will be resolved by the time those options are set to expire. And while the March options are also subject to that same uncertainty, it's not as significant of a factor, so we should expect the volatility to decline after it's resolved. To understand where the volatility is likely to go, we can calculate the forward volatility for the options at each strike and construct the forward volatility skew. This skew represents the expected volatility the March 18th options will trade at once the February 19th risk is cleared up. And while we often think of volatilities in terms of their absolute strike prices, another way to think of them is regarding them based on their relative moneyness. In this case, call options at 105 are $4.71 out of the money. The forward volatility for that moneyness in the target term is 27.38. As a result, if the price of the underlying were at today's price on March 5th, we could reasonably expect this call to be trading around a volatility of 27.38. To determine the appropriate volatility used for different underlying prices in the future, we can simply shift the skew the appropriate change in price such that the moneyness lines up on the future date. And then once we have the volatility for each future price, we can complete our book valuation from earlier. Now when it comes time to chart these future book values, they're not used as is. Instead, the relative market change from today's value is used in order to provide context that's more useful in decision making. Let's say the underlying has dropped 3% and we want to see how it affects our potential future. This chart shows a model of the market value change from March 5th relative to what the stock is worth today. It doesn't account for the cost basis or any other factor. It simply values the future book based on each price path and then subtracts the current market value to illustrate the change. This becomes especially useful when experimenting with potential book changes. For example, what if you wanted to understand how selling the shares and buying a call at 100 would impact your risk-reward potential on March 5th? With this approach to charting, it's easy to see. To recap, our book valuation technique is designed to accurately model the projected change in market value of a given book on a future date. We also make sure to include your cash changes so that you get the most accurate insight as to how you should expect performance over that period of time. As always, good luck and good hunting.